Welcome back, everybody, to episode, I think we're on 12 now of the Talking Stocks podcast. My name is Joe. I'm here with Todd, as always. How you doing, Todd?
I'm good, Joe. How are you today?
Doing all right. It's been quite a week, huh?
Oh, it's been a crazy week. There's just like so much going on right now. And these are, I don't want to say they're unprecedented. I saw a funny thing, Joe. It was like, I can't wait for precedented times again.
Seriously.
It's like, yeah, we're all done with unprecedented.
Oh,
Forget
yeah.
unprecedented. I just want some precedented, boring times.
Yeah. New Year's Day 2021, I think, is going to be a very hopeful day for everybody. I sure
It
hope
is,
so.
it is. And the hope is going to be normal. I just
Yes.
want
Just some normalcy, just to be able to, wake up and know what's going to happen today would be very nice.
right.
So,
I'd rather just not, our hearts can only take so much of this, of the crazy that we're enduring on a daily basis.
right.
And the stock market itself just completely abnormal with some of these
Oh,
unprecedented
gosh.
things.
Yeah.
I know that you want to kick us off talking IPOs, but before I forget, I saw this stat on IPOs and I was just like, well, that tells me something. And what it was the number of IPOs that double per year. And so it showed, from 2010, 11, 12, 13, how many per year double on the day they launch. And, 2011, 12, it's like 1, 2,
Yeah.
3, 1, 2, 3, 1, and then you get to 2020, 18.
Oh my God, of course. Yeah, to be expected. So since you brought it up, Airbnb, that would have been number 18, right?
It might be 19 now. I don't remember if I saw it
I guess that could be
yesterday.
19, yeah. Yeah, crazy day yesterday, huh? Airbnb and then DoorDash the day before.
Well, we last week's show we were talking a little bit of Airbnb and how I would approach it, and what I had said was I'm not going to buy it on day one because I feel like it could just be trading crazy. But if I get allocated, I'll buy it and I'll sell it on day one. And so, sadly, I did not get allocated. It went off
Bummer.
at what, $60-$70 a share. We're trading. It's actually up today. Looking at my screen, 148 as of the timing of our filming here on the East Coast. That's just crazy. And then the stats, Joe, like showing that the valuation of it is greater than like 3 of the largest hotel chains
Yeah,
combined.
Marriott, Hilton, and Hyatt. And then there was something else thrown in there. I forget if it was Expedia or one of the other booking companies, one of the big booking companies. Yeah, all of them combined. Yeah, crazy
I guess
times.
the argument is that you pay up for quality, you pay up for the leader, right? And yeah, I get that, but it's not normal for IPOs to be doubling. Sure, hey, you know what? If you can get allocated and you can double your money in a day, ride that wave until the wave stops, whatever. But it's not normal, and investors need to be careful. DoorDash, same thing. DoorDash, I think, is a little bit different than Airbnb because to me, Airbnb is de facto the leader. It is a premium play within that space, right? DoorDash to me feels like it's a little bit, that's more of a competitive space. There's still other players out there that have some pretty good size.
Yeah.
And I do still worry a little bit about food delivery. And because, as you know, we teach the How to Talk Stocks class at the University of New Hampshire. Anybody who's from the class who's watching, pound the subscribe and the like button.
Please.
Help us out. Help us get the YouTube number crunches to uplift our site. But we do that course, and I talk to them and I'm like, well, what food delivery do you use? And it's whichever one's cheaper. It's whichever one has a deal. It's not, I don't know how much how deep the moat is, I guess, for DoorDash. But I mean, hey, if you were able to get allocated, you just made a lot of money. Congratulations.
Yeah, absolutely. I know from experience when it comes to food delivery services or really anything that, people in their college students and people in their 20s use, there's very little kind of customer loyalty when it comes to stuff like that. And it's exactly what you said. Like, college students, they don't have a lot of disposable income. They don't have a lot of spare cash sitting around, and so they're going to choose what's cheapest, in the same way that, you know, they're going to go to the liquor store on the weekend and they're going to buy the cheapest thing on the shelf. They're not going to buy what they like the most.
I think that we could probably draw a comparison to the stock market.
I
Because it's, you know,
yeah,
not only, you know, you're choosing whichever is going to get the job done, but you're
right.
not necessarily choosing based on quality or brand or any of the kind of like the, God forbid, should I even say the word fundamental? Are we allowed?
What is fundamental?
Fundamental analysis, this crazy thing, or is it just, hey, I'm going to go out and I'm going to buy, I think Carnival is going to make me money today, you know, I'm going to buy Carnival or whatever it happens to be.
Yeah.
So it is kind of interesting. And what I'm really interested about too is that, you know, you see, you know, obviously you've got these smaller investors who are doing, we'll call them the Robinhood crowd, but it's not just Robinhood, it's elsewhere, who are kind of gaming this stuff, and they don't have unlimited dollars to be able to buy Airbnb, right? They
Right.
have to sell something else from their portfolio to buy Airbnb. So it is interesting to me to kind of say, okay, well, these, for the most part, I feel like a lot of these stocks are being treated like rentals.
Yeah, I agree. Like there are a lot of people out there on Twitter and on, you know, God forbid, on Reddit, who are really just, they're day traders, and they're looking to just game stocks. And I have a watch list now in Fidelity Active Trader Pro that's just like the stocks that everybody memes about on social media. And it's, you know, Palantir and Snowflake and Roku, and now DoorDash and Airbnb are on there. And to just watch how they don't follow really any market trends is staggering.
Yeah, it really is. It's a fascinating. It just shows you that, you know, social sciences, behavioral economics, behavioral psychology plays a huge role in, you know, in the short term, in market direction. In the long term, it's all earnings, right? It's the trend in
Absolutely.
earnings. It's the rate of change in earnings. It's the rate in change in operating margin. It's the rate of change in revenue. That's the stuff that drives long-term returns, but that's not what we're talking about here. We're talking about investors who are truly, like you said, kind of day trading, kind of flipping it. They're treating it more like a game. It's kind of like a sporting event. You know, did I win today?
Yeah.
Did I lose today? And that's risky. I mean, that's scary. I mean, I've seen this before. I mean, people are gonna wipe out. And I will tell, you know, I mean, I've tried to make, I've made and lost money in a lot of different ways. You know, I tried day trading, you know, I mean, I made a
Yeah.
lot of money at one point day trading, and then I lost a lot of money at one point day trading. And I learned lessons from that. And one of the lessons I learned is that, you know, if you're convinced that you're smarter than the market, right? And you're just going to say, I'm going to day trade, fine, so be it. If that works for you. The only people that I know who have been to consistently successful, and when I say consistently successful, I mean over decades, in very short-term trading, have been the people who have taken money out of the account every week and put it in another account. So if you're out there and you're gunslinging, one piece of advice that I would have is just make it real. Make the money real. Take out 50% or some percent of your gains in that week and stick it in another account. Because at some point, you're going to wipe that account out, and you're going to want to have this other account of money sitting behind you that you can either use to refund the account, or that you can say, well, that was fun while it lasted.
Yeah. Yeah, for sure. All right. So insert segue here. I want to shift gears, and before we started recording, we were talking about there's more really good, really hopeful and optimistic vaccine news this week, which, if you're not aware, is the emergency authorization that Pfizer got for their vaccine with BioNTech. And it can be assumed that when we're recording next week, Moderna will have that same approval from the federal government. So what we were talking about before we started recording was obviously there's Pfizer and there's Moderna and there's AstraZeneca, you know, the companies that are making the vaccines. But we were talking about these kind of behind the scenes players that have a role in the vaccine rollout. So one that came to mind for me was Cardinal Health, which makes a lot of like medical supplies. And I'm sure there are others, you know, like who's the questions that kind of go through my head are like, who's making the needles, who's transporting the vaccines, who's making the refrigeration systems, et cetera, et cetera, et cetera. So I know you had at least one that you wanted to bring up. So go ahead if you want to share a chart or whatever. Go
Yeah,
for
so
it.
Joe, what you're really talking about there is pick and shovel investing, right? The whole concept of the people who really made a lot of money during the gold rush in the 1800s weren't necessarily the people who were panning for gold. It was the people who were selling them the picks and the shovels and the things that they needed to be able to do that work. So the question then becomes, well, is there kind of a pick and shovel type oriented play towards in the vaccine space? I mean, we do in the vaccine space, probably the highest scoring in our research right now. By the way, free trial, you can subscribe below. I'll have a link in there. Go ahead and click on it. That gets you a free trial to the research. You'll be able to see the whole list of all the stocks that screen well for us this week. But the highest scoring one of those, Joe, is Pfizer. So if you're going to go out there and you're going to buy one, okay, buy Pfizer. But
Yep.
I mean, to some degree, the question is how much of that pricing is already baked in. So I wanted to share just two stocks that popped up on my screen. One, let me just do that now. So if you're on the podcast, we do post these on YouTube, so you can see the charts. We'll try to, you know, if you're not on YouTube, we'll try to walk you through what we're seeing on those charts. But you know, to your point, is there a company out there, Joe, that does kind of like supply these kind of things? And the name that jumped to mind was Retractable Technologies, which is a small cap company, symbol there RVP, so Reagan, Victor, Peter.
I'll put that in the show notes too.
Yeah, and you know, one of the things that's really interesting, obviously, that what they do is they have needle devices, and they have they've inked over the course of the last year some pretty big contracts to supply those needles for use in the vaccination program. And you can see, Joe, just by looking down at the chart here, you've got in the most recent quarter 27 million in sales. That's up 133%. And prior to that, 21% year-over-year growth, 41% year-over-year growth, and 53% year-over-year growth. And an expectation, it's not very well followed. There's really no analysts that are tracking this, but expectations for the company to be profitable on that. You can see this is not a new idea. I mean, the stock has gone from basically, you know, $2 to $12 since March. I have no idea if this thing has more gas left in the tank or not. I would consider it to be a very high risk stock. And the concern that I would have, Joe, is that with any of these kind of things, is how much are these things commoditized? You know, I mean, yeah,
Right.
Retractable Technologies has this, but I mean, you've got a lot of medical suppliers out there, and you know, they're investing in capacity and manufacturing capacity. And at what point does the capacity of these kind of ancillary products, you know, exceed the demand again? And does this end up being just a short-term blip where, yeah, it was a windfall, but the windfall was really just came and it went. So I think that's something to keep in mind. And then the other one was kind of more of a backdoor play where you're saying kind of a recovery play where you say, okay, well, post-COVID, in a post-COVID world, recognize that a lot of people have been infected. What companies may see some tailwinds to demand that are longer lasting? And one name that came to mind that's high scoring in the research is ResMed. Symbol there is RMD, Reagan, Mary, David. And ResMed makes the BiPAP machines and the CPAP machines that people most often think of for things like sleep apnea. So, you know, you wear these masks on your face and it helps you with your breathing throughout the course of the night. Well, one of the things that we've seen with COVID is that it does create some damage to the lungs and in damaging the lungs creates some lung capacity issues. And in those cases, you may end up being put on one of these CPAP machines for some period of time. So we're going to want to watch and see what management has to say about that, if the tailwind is small, if it's just a small number of people, or if it's actually more of a meaningful and longer lasting tailwind. But, here's a company that's growing its earnings, 476 in 2020 from 364 in 2019, climbing on an, as far as analysts are concerned, up to 553 in 2022. That's solid high single digit annual growth. And then, on the top line, you're seeing the same thing, 10% year over year growth last quarter to about 751 million. So those would be, just two for people to throw on their watch list.
Yeah, absolutely. That's great. And also, I will put Cardinal Health CAH in the show notes. I like to write these down as I go, so folks are aware. So I know that you wanted to touch on, or maybe dive into, I'm not really sure, I'll let you decide, kind of this this black cloud that might be looming over us right now in terms of certainly the overbought indicator that we talked about last week, and yeah, just kind of like what history tells us we might be headed towards.
Yeah, should I pour some cold water on the party? I don't know. I mean, it's like, okay, so what I'll do is there's a few different indicators that I use. I don't think you should use any one single indicator when trying to decide if something's overbought or oversold. Our overbought and oversold measure does a pretty good job of showing us when there's a lot of optimism and a lot of pessimism. But even with that, I incorporate other things. And so I wanted to share 3 different indicators with listeners and watchers today that have me concerned and have me worrying over a pullback. The caveat that I would say, Joe, is that, yes, I think the odds are much higher of a 5 or 10% pullback than they were 2 weeks ago. But again, I'm not expecting some sort of crazy free fall back to the March lows. That's not what I'm saying. I mean, Obviously data dependent, right? Free to change my mind later. But I really am just at this point just modeling. Yeah, I think that we're getting a little overheated. We could see a 5% to 10% pullback in the indexes, which, some of these stocks, especially some of these higher flying stocks, I mean, they could fall 20% or more as far as individual stocks. So I want to walk you through that. So I'm going to go ahead and share my screen again and kind of show you what we got here. So we're on the Seeking Alpha website, and I just put up, it's Free Research Friday today. So we just put up some free research. Again, you can go right to Seeking Alphas. Right now we're trending. We're the number 4 trending article on Seeking Alpha. Best big stops to buy on a pullback. So let me open up that article. And again, listeners and viewers, you can just go to Seeking Alpha and just Google or seek in the search window, type in Limelight. You should be able to find the article if it's not on the home page. But one of the things I say here is our overbought indicator suggests the market could experience a 5 to 10% pullback. And then I show 3 different things. The put and call ratio, the AAII survey results, and our own indicator. And I just want to walk investors through all that real quick. So last week we saw something really interesting. We saw the put call ratio, which is a simpler reason, it's a ratio showing the number of people buying puts, number of people buying calls. When that ratio gets really low, it suggests that people are incredibly optimistic and they're not really buying a lot of protection. And what we saw last week is that the put call ratio traded below 0.40 for like 4 consecutive days, and almost had a 5th consecutive day, but we did have a down day. I think it was on Tuesday or Wednesday. And that's the lowest rating that we've seen on that since the Great Recession. So on its own, the put call ratio getting down to these levels might be saying to us, all right, people are getting a little bit too optimistic. There's a little bit too much froth, and maybe we need to create a little bit of fear in the market. So that's that first chart. And you can see here, I show how going back to 2011 and us going down all the way here to 0.42 as in the most recent day. But like I said, we did trade below 0.40 for 4 consecutive days. And then every week since 1987, the AAI, which is a group of investors, has done their investment sentiment survey and asked people, okay, are you bullish or are you bearish? And it's kind of a contraindicator when you get to extreme levels, Joe. And one of the things that's interesting is you had that ratio was at the lowest in 11 months last week, the ratio of people who are responding bearish. So it was around 22%. And even in the past week, as some people have gotten a little bit more conservative, it's only up 4%. So it's still at 27%, which is still historically pretty low. And that's basically asking the direction that members believe the stock market will be heading in the next 6 months. So 48% believe that it's heading higher over the next 6 months. 27% believe that it's heading lower in the next 6 months. And usually when you get really low readings on the bearish, that's also a concerning or a warning sign, a concerning indicator. And then finally, Joe, I wanted to point out that same chart we showed last week, just updated with this week's data. This is our universe. We track in the research about 1,500 widely traded companies. So it's not penny stocks. These are all institutional quality stocks, things that mutual funds and ETFs would own and that you could also go in and own. And we track those stocks to see what percentage of them are trading 5% or more, the 200-day above the 200-day average, or 5% or more below the 200-day moving average. So picture the 200-day moving average kind of as your baseline, and what we're in a band of 5% on either side. And what we're trying to do is trying to find the outliers up here that are really high or the outliers down here that are really low. And what we found is that when you get really extreme readings, so really high levels of stocks, of the percentage of stocks that are above their 200-day moving average and below the 200-day moving average, it's actionable. So either too optimistic or too pessimistic. And you can see in this chart that I'm showing on the screen, we were above 70% last week, which is unprecedented. Back to unprecedented, right? Unprecedented.
Yeah.
I want some precedented times, damn it. So you get these unprecedented readings above 70%. And that's this blue line here, showing that 70% of our universe is now trading more than 5% above its 200-day moving average. That actually went higher this week. We're up to 76% now, trading greater than 5% above the 200-day moving average. Now, all of these indicators can stay flashing warning signs for a while. And markets will always rally further up or down, or they'll fall further down than people expect, right? But I think when you take all of this data together and you look at it, it makes me think that this is actually a pretty good time for investors to be saying, okay, I'm going to reduce my leverage. I'm going to be thoughtful about the stocks in my portfolio. I'm going to be selective. I'm going to pull the weeds and prune the trees. So I'm going to get the stuff out of there. There were laggards, or maybe I was just holding on to it, but they're doing well, because the market's doing well. But do I really have very high conviction in that stock? Maybe not. So let's get rid of that. And then maybe as far as pruning trees, you look at a stock and, if you're up significantly in it and it's now a weight that is really out of bounds for what you normally would expect a stock to be in your portfolio, sure, trim it back, free up a little cash to have on the sidelines. And just as for something to gauge it on, I have about 12% now in cash from doing the weed pulling and the pruning.
Yep.
So that's going to give me plenty of flexibility to buy some stocks on sale. So use the next couple of weeks to kind of be doing that with your portfolio, freeing up some cash, getting some money ready to deploy, and then use our watch list, use whatever watch list you tend to want to use to create new lists and set some target prices, because you might be able to buy some stocks on sale soon.
Yeah. So since you brought it up, what are some of the stocks that you're eyeing to potentially buy on a down day in the next few weeks to maybe a month or two?
Well, we always talk, Joe, about sector and industry allocation. I think that's important. You've got the market as a huge tailwind, right? With most stocks going in the same direction that the market goes. And then you can drill down further and you can say, yeah, you know what? sector and industry also plays a big role in whether or not stock is rising or falling. So my focus would be stay within the highest scoring sectors and the highest scoring industries in the research. Again, free trial in a link in the comments section. Right now it's financials, it's industrials, it's consumer goods. And then if you're really focused on maybe more aggressive parts of the market like technology, like drone technology, that's where you would then have to drill down deeper and say, okay, what industries are strong in technology? And right now you'd still want to be taking a look at those semiconductor names. And then maybe if you miss the semiconductor names, those would be good ones to put on your watch list and say, okay, if some of these semis start to pull back, because they've moved 20, 30, 50% in some cases, if some of those drop off a little bit, maybe I'll go in and add some of those. So that's something to keep in mind. And then on an individual stock basis, we like to do this every week. Subscribe or hit the like button to make sure that you see this every week. We do highlight individual stocks that are screening well in our research. So what I'll do is I'll go back and I'll share my screen again, and we'll pull up some charts that caught my eye as I was going through the research this week. And okay, so Joe, just give me a thumbs up that you can see the charts. Yeah, okay, yep. Awesome. So some of these I own personally, and I'll let you know which ones I own personally. And I've owned them for a long time. None of these are new buys for me. I've owned them and I'm gonna stick with them. The first one is Monster Beverage. I think Monster Beverage is intriguing right here.
Interesting.
Yeah, I mean, you look at this and 10% year-over-year growth in the most recent quarter. You had that one blurb here in the second quarter, but again, 10% year-over-year growth in the prior 2 quarters to that.
Hey, Todd, sorry to interrupt, but we can't see the chart.
Oh, it's not showing?
No, it's not.
Well, what the heck? Let's see if this works. All right.
Sorry about that, viewers and listeners. We had a little technical difficulty there, but we are back and we have a chart now.
Yeah, everything, patience pays off, people. Patience pays off. Yeah, so, okay, so we're back in business. We've got the charts up so everybody can see it. The first stock that I'm highlighting is Monster Beverage. I started talking about Monster Beverage and having double-digit top-line revenue growth. I do love that. That's one of the things I like to look for whenever I'm going out and evaluating a company. It also has mid-teens, 14% expected EPS growth next year and the year after. So, I mean, if you're looking for a beverage company to throw in, consumer goods company to throw in to the portfolio, maybe add Monster Beverage to your watch list. And if you can buy it in the low 80s, ideally, something like that, 81, 82, that might not be a bad entrance. Last week, Joe, on the show, we were unconventionally mentioned energy stocks. We highlighted 3 of them.
Yes, we did.
We hired Halliburton, we hired Core Labs, and we hired Diamondback, FANG, symbol FANG there. All 3 of them done very well over the course of the past week. Might be worth continuing to dip toes in the basket. Valero is the one I want to mention this week, VLO, and that's in the refinery space. And, again, this has been an impaired basket, so it's not going to screen well on some of the things I typically look for. Like it's going to have the negative year-over-year revenue growth, right? But 2021 estimates are rising. They think they go from a loss in 2020 to positive earnings back in 2021. And refiners, they typically end up doing pretty well for the next 6 months. Historically, if you look at seasonality, not a bad time to be thinking about putting a refinery into your portfolio. So that's a name that I would also consider. I own this next one personally, Lululemon. Lululemon reported what I think are pretty much blowout results last night after the bell. And as a result, because this is upside down land, stock is trading down.
Typical.
Pretty sharply. And I mean, we've seen that, right, Joe? I mean, people get really excited about the earnings, they bid up ahead of the earnings, and then once the earnings happen, people say, I'm moving on to the next idea, right? Use that to your advantage, right? Yeah. I mean, this is a high scoring stock. It grew during a pandemic, and this was a retail focused store where you've got, most of its revenue being generated from actual physical stores. And yet they generated 22% year-over-year growth last quarter. And
remarkable.
A lot of that was because of triple-digit growth in their e-commerce channel. right? They also bought Mirror, which is, basically it's a mirror, lets you work out in front of it, gives you a lot of kind of like that one-on-one experience that you would theoretically be missing because you're no longer going to the gym. And of course, a highly profitable company as well, Joe. $4.26 expected in 2021, climbing to $6.49 in 2022. So again, I like to do this, Joe. If we see stocks in our research that are screening well, I'll throw them on a list. And if I get an opportunity like this where it's down 5% or whatever, not a bad time to take a slug of it, put it into the portfolio and see what happens. I'm also a fan of Etsy, ETSY. That stock is breaking out. It's not pulling back. If you don't own it yet, maybe if you can get it in the low 150s, that'd be a good target. So if we do see, the market can come back a little bit, maybe go ahead and grab Etsy, because again, fast growing company, highly profitable, leveraging it. And then you might want to take a look at in healthcare, which is a relatively poor scoring basket for us right now. The sector screens below average, but there are individual stocks within healthcare that you may want to consider. We mentioned a couple of them earlier in the show. New to coverage, Health Catalyst. We just added this one to our coverage last week, and stock is behaving very nicely. Rising volume on up days, low volume on sell days, 20% year over year in the growth in the most recent quarter. Earnings expected to turn profitable in 2021. And basically what this company does, Joe, is it's a number crunching kind of company that helps you figure out workflows for healthcare. So if you're a healthcare company or a healthcare provider or healthcare system, and you're looking to try and make sense of data to be able to be more efficient and maximize revenue and profitability, then maybe you would contract with Health Catalyst. So there's a smattering of stocks for you that you can consider putting on your watch list.
Awesome. Yeah, I wrote all of those down, and it is quite the list this week. We're going to have some extensive show notes for our viewers and listeners, which is good. Lots of great ideas, and of course, plenty more ideas in our weekly top stocks lists. There will be a bunch of those coming out later this afternoon, alongside this podcast. So, yeah, hope you'll take a look at those for sure. And I guess with that, I'll see if you have any parting words of wisdom for us, and we'll sign off until next week.
No, my dad had a sign somewhere up. I might have mentioned in previous show. He said something like, "Proper planning prevents piss poor performance." I think 5 Ps or whatever it was.
Yep.
We'll just say poor performance. We're a family show. But I think that's really what we're talking about here. We're saying just be prudent. Be prudent. Right.
Absolutely.
I mean, on the show, we always talk about it. We're not fans of margin because margin cuts both ways and margin rules can change. We're not fans of short-term option trading because options, time decay really makes it a tough battle, especially if you're coming into a tough period. So, when you get periods where optimism is running high, it's just think prudently. And I think that, those are kind of the rules and the systems you put in place now that are repeatable that you can use for decades.
Yeah. All right. Well, I think that was a pretty good episode, if I do say so myself. So with that, we'll leave it there. And yeah, hopefully we'll have more good news to report on next week. Please be sure to smash that like and subscribe button below. And yeah, we'll see you next week. Take care, everybody.